Awesome. Awesome. All right. The next type of liquidity is key zone liquidity. Like I said before, we have traders like myself way back when who traded from zone to zone. So this is called key zone liquidity. In this instance, what do retail traders see when they're identifying key zone liquidity? Key zone traders are viewing a zone that has been used several times for both buys and sells in the past, and it acts as a zone of contestation. So when you see over here, this was used as rejection. Over here, price broke it, used it as a support. Price broke it again, used it as a rejection, right? Rejection. Then in the future, right? What did price do? Came back and kind of used it as a support, then used as a resistance, another support, so on and so forth. It's a zone that is indicated by buys and sells that are both lining up in an area, right? So of course we have all of these equal lows down here. We know that this is an area of key zone. Also here, we see that we have a zone of equal highs or still more key zone, all used as one touch, two touch, three touch, four. So what's the point behind this, right? Whenever a zone is broken, retail's gonna be looking to sell on the retest of a zone. Whenever a zone is broken to the high, they're gonna be looking to buy on the retest of that zone. So why do retail traders use this? With retail logic, it makes sense to take positions at areas that have continually been rejected off of. And once broken, looking for the retest of that area. Once broken, look for the retest to then continue to trade in the opposite direction. Market conditions, specifically key zone liquidity, this occurs in ranging market conditions where there's a lot of ranging going on for buys and sells. That's going to build that layer of key zone levels. We got another 15 seconds, and we're going to continue forward. I'll give you guys another few seconds. Keep going. Again, if you don't write something down, have questions, refer to on your piece of paper. All right, key zone liquidity. Again, furthermore, there are traders buying and selling within a range with no clear bias, and they fall into these traps of areas that act as a turncoat support and resistance that have several rejections and retests. This is the same image we saw to the left, right? And then what do we see? If you see a price that has been rejected as a resistance and then a support, if you look for an order block over here, it will not work. So the purpose is we are looking specifically for retail traders to get positions within the range, unsure of their bias, right? So it's causing them to be in both buys and sells because they don't know which direction the market's going. How do we view this? Is going to be based on the liquidity perspective. We identify bullish or buy order blocks below these zones and sell order blocks above. So if you see an area that was previously used as a break and retest, or a key zone that was broken a zone and then it retests the zone, do not look to buy there, because every other type of key level trader is going to be looking to buy there. If it's used as a resistance right in the past and it breaks it, don't use it. Don't look for an order block that lines up with your key zone. Do not. Don't get caught up in the choppiness. If you're looking to buy below, right, a key zone level. If you're looking to sell, right, if you see a previous level broken, sell above your key level zone. If you're seeing a key zone, do not sell in the zone retest of it, sell above the retest, or better yet, just outside of the zone as a whole. The expected outcome in these scenarios, price will continue to accumulate retail positions within the range in order to gather enough liquidity to create an impulsive move to break the range. All these traders, again, over here, who are looking for sells, where are their stop losses, right? These sells are in place specifically to cause a whole bunch of liquidity or retail sells stop losses to be above these highs. So that's why they're building this whole range. One end of the range or the other is going to get broken, and the range internally will stay intact, and the lower end or the right end of that range will remain intact to then break the wrong end where all the liquidity is building. So you can might say, well, there's all these, there's all the support. Yes, there is all that support, but there's a specific reason it works, and you're going to learn here in just the next block. All right. So key zone is the next one. So now what I want everyone to do is go ahead and identify the areas with a box tool, a line where there's clear sells that are being used, clear buys, and then all in between buys and sells that are being rejected in the same place. So go ahead and identify like the key levels that make a lot of sense. Give you guys 15 seconds, 20 seconds or so. And there's no specific rules for this. It's just what seems to be the most liquid areas for these types of traders. I know it's always going to end up being like drawing book. I just want to see. Exactly, right? So give or take, you guys all have these zones drawn out right here. I'm going to stop annotating for a minute. You guys have all of these zones drawn, right? That was pretty synonymous. Now, again, we see over here, rejection, rejection, rejection. Over here, uses as support, resistance, so on and so forth. To the buy side, clearly used as rejection, here, used as support, right? So after you identify this, the next thing that we want to identify is specifically what? Identify the order block or blocks that are lying after the zone. So if I ask you guys this question, after you identify the key zone liquidity, where do you think we're trending at this moment in time, just based off of the limited information that you have? Are we going up or are we going down? Right? So what's just the most obvious? That's the most thing I've asked. I know it's not trading view, but this is what's needed before we go to trading view. So in this instance, we're actually trending up, starting from left to right and draw a trend line. We're bullish in this scenario. All these new sells, they're just there. That's not the pre-existing trend. So after we identify we're bullish, and remember what we said about the zones, we look for order blocks below the zones, identify the valid order block or blocks that would tell us that we're ready to buy higher now, because we're projecting a forecasted move. So what are the order blocks that lie below these zones? All right, yeah. Boom, right? And that becomes pretty simple as is. You just have to identify the order blocks are lying just below. And we see here that exactly as you guys have analyzed, we have this order block immediately below. Immediately below, right, below this level. And yes, of course, we also have this one here. So the next thing to do is anticipate what's going to happen, and based on what we've already done, we know that we have to collect some form of liquidity. Over here, we have all these traders here. We have these traders looking to buy here. No matter if there's an order block here, it will not work because it is aligned with a break and retest zone. It will not work, or key zone rather. So knowing it won't work, we can expect price to come lower, right, below to take out these buy stop losses, and then we can potentially expect what? Collecting the gas to get to what destination. Exactly. All of these equal highs all the way over here. So we can expect this, or we can expect something like this. Either or, right? Now you'll know exactly which one has the highest probability of happening later on